I just think that we have a major crisis coming, a sovereign debt crisis, a currency crisis, a banking crisis, financial crisis. I mean, it's going to be horrific. We've been kicking the can down the road for not only years, but decades. And during that time period, the problems have just been built up to an enormous degree. Had we confronted these problems years ago when they were smaller, I mean, granted, they were still huge, but not, relative to how they are today, the crisis would have been smaller and easier to recover from. But because we succeeded in postponing the inevitable, what we're ultimately now going to be confronted with is far worse.
In a recent analysis, Peter Schiff, the American stockbroker, financial commentator, and CEO of Euro-Pacific Capital, has voiced significant concerns about an impending economic crisis. Specifically, Schiff has highlighted the imminent risks of a sovereign debt crisis, currency crisis, banking crisis, and an overarching financial crisis. Drawing on his wealth of experience and insight, Schiff observes the current economic landscape. The annual rotation of members on the U.S. Federal Reserve Interest Rate Setting Committee for 2024 suggests a slightly more hawkish stance compared to the outgoing group from 2023. However, Schiff argues that this shift is unlikely to alter the outlook for a pivot to interest rate cuts in the coming year. Contrary to conventional expectations, some analysts propose that if inflation declines more rapidly than anticipated, the Federal Reserve may be inclined to implement even more substantial rate cuts than the 3 AR of a percentage point implied in recent projections. Schiff emphasizes a notable increase in interest rates, challenging the Federal Reserve's assertion that raising rates is a strategy to combat inflation. He contends that the actual impact on the cost of money is substantial and extends beyond the central bank's narrative. Despite the Fed's preferred inflation gauge shilling a 3.2% annual rate in November, slightly below expectations, Schiff criticizes the central bank for downplaying the effects of interest rate hikes on various costs, expressing a more pessimistic view. Schiff predicts a future characterized by high inflation, elevated interest rates, and stagflation, highlighting that the markets have not fully priced in these impending economic realities. He suggests a potential discrepancy between official projections and the actual trajectory of the economy. The current economic landscape is marked by rising costs in essential commodities, increased interest rates, and the looming specter of inflation, signaling that we are now facing the consequences of postponing necessary actions and making deals to delay the inevitable day of reckoning. To explore the valuable insights presented by Peter Schiff and stay updated on our newest videos, subscribe to our channel and turn on notifications. What are your thoughts on this analysis?
But I think the reality is it's gone up more than that for most of the things that are essential: food, energy, now insurance, and interest rates too. People forget, we had interest rates at 0 for a long time. Mortgages were 3%. Now they're closer to 8%.
Yeah, wow.
That is a big increase in the cost of money. And people are paying that, but that's part of your cost of living. You can't ignore that. The Fed is like, oh, we're fighting inflation by raising rates. But what about the rates? They're a lot higher. That's a price. That's the price of money. Everything is affected by that. If you are a business and you have various costs, you have labor costs, you have raw material costs, you have rents, but you also have interest. Maybe you've borrowed money to buy a capital equipment that your workers are using, and you had an adjustable rate financing on that debt. That cost has skyrocketed. That's part of your cost curve. You've got to pass that on to the end customer, just like you have to pass on, your raw material costs, your labor costs. So the Fed just acts like these interest rates have no effect. They have a huge effect. That doesn't mean they shouldn't be raising rates. They just have to acknowledge the big effect, because when they kept interest rates really low, that's one of the reasons that the inflation numbers officially were low, because businesses passed on these low rates. They could afford to charge lower prices because their interest costs were so much lower. But that's all changed. So none of this is going to fight inflation. That's the market just doesn't get it. Yep. The days of low inflation are gone. Inflation is going to be very high for as far as the eye can see. And that's what the gold markets haven't priced in. That's what the bond markets still haven't priced in. The dollar, they still think we can go back to where we were. We can't. That was an aberration. That only existed for a brief window in time. And because we had that, now we're going to have the payback. Now we're going to have the flip side, which is going to be high interest rates, high inflation, stagflation. We basically made a deal with the devil to delay the day of reckoning, and the devil's here to collect. Now, I think at this point, we've reached a fork in that road, and no matter which direction they kick it, it's a disaster. So the Fed can do one of two things. The Fed can keep on fighting inflation and keep on hiking rates and allow a financial crisis that's worse than 2008 and with no bailouts. Let the banks fail. I mean, the banks are in worse shape now than they were in 2008. Nobody understands this. And I just talked about this on my own podcast, but the problem in 2008, 2007 was foreclosures. People weren't paying their mortgages because the value of their house went down. And so they just weren't paying. Or they had an adjustable rate mortgage and they could no longer afford it because the rate went up, right? And there was no incentive to make the payments because they were underwater. So it was losses on bad mortgages that were the problems for the banks. But it was only a small fraction of the mortgages that went bad. Most of them were okay.
According to a recent report by the Wall Street Journal, prices in the United States saw a decline in November, marking the first such drop since 2020. This development is seen as reassuring, suggesting that the U.S. economy may successfully avoid a recession while gaining control over inflation. Data from the Commerce Department reveals that the Personal Consumption Expenditures Price Index, the Federal Reserve's preferred measure of inflation, decreased by 0.1% in November compared to the previous month. Despite this decline, the year-on-year basis still indicated a 2.6% price increase, remaining close to the Fed's targeted 2%. In response to these findings, Peter challenges the common belief that falling prices, often associated with deflation, are inherently detrimental to an economy. Contrary to this notion, he argues that a negative inflation rate, such as -1% or -2%, might be more favorable than maintaining zero inflation. The report emphasizes the positive impact of the declining inflation rate and the optimistic sentiment among consumers on the resilience of the U.S. economy. Despite the Federal Reserve's tightening policy leading to the highest interest rates in 22 years, the nation has managed to avoid slipping into a recession, aligning with Peter's perspective. The report underscores the importance of distinguishing between inflation and deflation. Now, let's return to the interview for further insights.
If we had a rate of -1 or -2, that's better than zero. I mean, there's no reason to think that we need prices to stay stable. I mean, stable is better than rising by 2% a year. But they've even redefined stability to mean rising 2% a year. There's nothing stable about a steady increase other than the rate of increase is stable, but the prices themselves are not stable. And, before we had a central bank, when we were on sound money, on a gold standard, prices went down. If you look at the CPI, and you can get these statistics, and you look at the CPI in 1900, and you compare it to the CPI in 1800, prices were cut in half over 100 years. So that's 100 years of falling prices. Now, they want to call that deflation or rising prices inflation. Inflation is the expansion of the money supply, and deflation is a contraction of the money supply. Prices are separate, right? Prices don't expand and contract. They go up and down. Inflation and deflation have to do with expansion and contraction. So they have to do with money supply. But there's no reason for prices to go up. Now, what the politicians try to claim is that, well, we need prices to go up because if prices fall, they say businesses can't survive. Well, yes, they can if their costs are also falling. What counts is margins. So you can make money in falling prices. In fact, companies make more money when prices are falling because they do more volume. Cell phone companies make more money today selling cell phones than they did 30 years ago. The price is much lower than they were 30 years ago because now they sell them to everybody. Back 30 years ago, only the rich could afford a cell phone. Now everybody can afford a cell phone because the price went down. Or they try to claim, well, consumers won't buy anything. If they think prices are going down, they're just going to indefinitely sit back and wait and no one's going to spend. Which again, if that was true, nobody would have a cell phone. Nobody would have a television. Nobody would have a computer. I mean, it's nonsense. People don't hold off on their consumption because they're waiting for a lower price. There's a value to today. Yes, I can wait. I can wait a year and get a lower price. but that means I have to go a year without the thing that I want. There is a time value. I want it now. If I could buy it 2% cheaper in a year, I'm not going to wait. I mean, what if I don't even live a year? I may be dead, right? So people want to buy. The only reason that people wait for a lower price to buy something is because they can't afford it. It's like, God, I'd like to buy that, but it's too expensive. You know, I use the example when I first saw a high definition TV. I went into like a Good Guys or one of these stores. And this is probably like in the 80s or not, a long time ago. And it was like the first high def TV I'd ever seen. And I thought it was amazing. It was like looking through a window. And yeah, I wanted to buy it, but it was like $10,000. So I didn't buy it because I couldn't afford it. Right? That's why I didn't buy it. And I thought, well, one day the price will be low enough and I'll be able to buy it. You know, but if the price had just gone up from there, you know, well, I mean, I could buy it now because I've made a lot of money, but a lot of people would never have bought those TVs if the price didn't.
Given the recent changes in the economy, Peter's ideas about inflation, deflation, and the money supply's expansion or contraction could reshape future monetary policies and public views. The positive consumer sentiment mentioned in the report adds another layer. This shift in understanding might affect how people perceive economic conditions and plan their financial activities. Evolving price dynamics, influenced by this nuanced perspective, could encourage more predictable economic behavior from businesses and consumers. If consumers believe prices will remain stable or fall, it may lead to increased spending, potentially boosting overall economic activity. We invite you to share your thoughts on these possibilities in the comments. If you found this discussion valuable, please subscribe to our channel and activate notifications. Your participation is highly appreciated. Thank you.